And for video number 2, auto loans. Now, I'm just trying to think back myself from 2015 and 2016, how often, or maybe how many times, just even guesstimating, did I, in each of those years, 2015, 2016, talk about the auto loans or the subprime auto loans, any of that stuff. And I almost feel like maybe in 2015, maybe not at all. I can't recall. I just can't recall. I know I've spoken about it in 2016, but I feel like maybe I've done a couple of videos and that might have been it. And then this year started, and I've already done at least 2 on the auto loan thing. And there's another one coming right now. We have some major problems. Subprime auto loans, this is from Wolf Richter. Subprime auto loans crushed worse than in 2009. Auto industry bleeds, knock-on effects commence. After the credit bubble comes the credit bust, he says. Subprime auto loans, a force behind booming car sales in recent years, are getting crushed by defaults, particularly those originated between, not long ago, 2013 and 2015, when the proportion of subprime loans began to surge. Hang on. All right, so let me start that again. I had some little children issues I had to deal with, if you know what I mean. Subprime auto loans, a big force behind booming car sales in recent years, are getting crushed by defaults, particularly those originating between 2013 and 2015. So we're talking just a few years ago. These are also, you would think, cars that should have been paid off by now. 2013, 14, 15, 16, 17, 4 years. Oh, wait a minute, that 5 year. That's assuming they got the 5 year, the 60 month. But what if they're in the 7 and 8 year deal? And they're realizing, I'm in this thing 4 or 5 years now. This thing's falling apart. I still owe a bunch on it. Come get it back. Which is going to do what? A lot more cars coming on the used car side of things, if you know what I mean. So I just saw an article as of, I don't know if it was this week or last week, maybe it was earlier this week, that just talked about just such a thing, about the glut of used cars coming on the market. So particularly those originating between 2013 and 2015, when the proportion of subprime loans began to surge while underwriting standards became loosey-goosey as private equity-backed auto finance companies with a ravenous appetite for risk, subprime of course, and securitization elbowed into the market amid the exuberance of the greatest credit bubble in history. What is a subprime loan? A subprime borrower would get a subprime loan, meaning you're not exactly the credit score-ish we'd like you to be, so you're subprime, but we want to sell and we won't say no to anybody, so come on down. High risk, subprime and securitization elbowed into the market amid the exuberance of the greatest credit bubble in history. Bad deals are made in good times, says the old banking saw. Auto lenders package their loans. And by the way, can I just say something? Actually, I'll give you a hint. You don't have a choice because I'm doing this video. But I want to pretend like we're having a conversation. Like if I just had to cut you off. You know what I mean? Make you feel like you're having a conversation together. Can I just say something? I'm pretty sure I've mentioned a few times in the past, and I mean a while back, that after the foreclosure stuff, the 2009, 10, 11 stuff, I said you're going to see the industry, as in financial lending, have to drop their standards. Why? Because they don't make money unless they have loans out there. And if everyone's defaulting and bad credit score, foreclosure, bad credit score, we're not going to have people to lend to. So we have to kind of loosen those little bits up a little bit, you know what I mean? And we're going to lend to people. So they've been lending to those people. Got to keep it flowing at all costs. Credit, no problem. Bad credit, no problem. Come on down. And this is what's happening now. This is now the result of that. And it's not just that these people are no good cheats. They probably live in a house, used to, got foreclosed, maybe sold, got walked from it, strategic default that was worth way more, they owed more than it was worth. Nonetheless, hurt their credit. All this was caused by the bankers. Let's not forget who was at fault. Now they got bad credit. but they're now having to rent. And the rent is very, very high. And that is the reason why they can't make their car payment. Because other things, especially rent, is too high. So even though they were subprime, they actually might not have been too bad of a person as far as risk goes. However, they have other really expensive bills they got to pay. And if you have to make your rent payment or your car payment, which one's it going to be? No brainer. Got to pay the rent. So I'm not happy to see that, but I guess I could say I'm kind of glad to see that my thought on that all these years ago turns out to be exactly what it is. Not that I'm some kind of genius, because a monkey could probably figure that out. When a whole slew of people who used to have credit can't get credit anymore, what happens to the banking institutions, the financial, the lenders? Well, there's not going to be a big pool to pick from. You're going to have to pick from the turds, so to speak, in the punch bowl. And you're going to find that we used to have a huge punch bowl and there's just a few turds. Now we've got this huge punch bowl and there be a lot of turds. And I can't handpick the good ones anymore. And I got bills to pay and rent to pay at this building and insurance and cars and everything else we need to get loans out for. Let me start picking some of these turds out of the punch bowl. Again, it was all caused by the bankers. So every little side reaction and sub-reaction, I should say, reaction, sub-reaction, is all because of what they did leading up to the 2008 crisis with the ninja loans. No, everybody's approved. That's what caused this. And now it just is in everything. Everywhere you look, from the retail apocalypse, subprime lending, again, real estate, it is at the peak. It is going down. So, auto lenders package their loans into asset-backed securities, ABS. I thought ABS was analog brake system. Nope. Asset-backed securities. And sell them as bonds to yield-hungry institutional investors. Fitch Ratings, which rates auto lenders and auto loan ABS or asset-backed securities, just reported on the state of the industry. Can't wait to hear this. Does mortgage-backed security sound familiar to you? MBS? And now we have ABS, asset-backed securities. How did those MBSs work out for us? Package them, rebundle them. Remember that? You're not telling me they were doing that in the auto loan industry, were you? Well, certainly they were. Asset-backed securities, and then sell them as bonds to yield-hungry institutional investors. You know, the guys who need to show performance on their pensions that they're dealing with. We got to show we're a good pension fund. We're going to get you that 8% at all costs. Only to find out, no. Anyway, so the Fitch Auto ABS indices show that 60-plus day delinquencies were relatively low for prime auto loans at the end of quarter four. But for subprime loans, they've surged to 5% of outstanding balances, the highest since at least 2008, during the depth of the financial crisis. What are the chances? Net charge-offs show a similar scenario, except only worse. Net charge-offs from prime loans ticked up to a still low 0.75% of outstanding balances, but net charge-offs from subprime loans surged to 10.5%. Guess the highest since when? Go ahead. Say it. I can hear you now through psychic powers because you know the answer. Since 2008. Isn't that amazing? Not my psychic powers. I mean, 2008. Ain't no psychic powers here. My psychic powers are this baby. See this? Magic 8 Ball? That is Jason Ipfor's psychic powers. It's just as good as anything you will hear on TV, MSNBC, The Expert. It's just as good. Subprime is particularly vulnerable, Fitch says. It expects credit performance to deteriorate even further. No kidding. But I thought the Trump trade, Trump won, he's going to fix everything. And again, I want him to win. I want him to do what he says he's trying, and I want him to succeed badly. But when I have hard data in my right hand, and it's chock full so much that I can't even hold it, and I've got fake data Magic 8 Ball data, fake. Just give me a nonsensical response and I'll tell that to the people on TV and tell them not to worry. Which one are you going to pick? I have no choice. I've got hard data over here. I have hopium over here on the left hand. Anyways, simultaneously, another trend is biting lenders and investors in subprime auto loans, and that's the ABS, asset-backed securities. Again, mortgage-backed securities, asset. Here we go. Here we freaking go again. While for the overall market, average loan terms have reached a record 67 months. For subprime borrowers, they've jumped to over 72 months. Once again, let's just keep extending it. Let's extend and pretend, as they say. Can't afford a 60-month? I'll make it 62. Can't afford 62? I'll make it 72. Where do I, 80 months? What do you need? Just let me know. 92 months? Just keep, whatever you need. I got you covered. And they're still defaulting. And they're still defaulting. Defaults are up. Fitch adds, let's see here, the data conflict with commentary from several large auto lenders that have suggested the loan term extensions in recent years have been primarily targeted as prime borrowers. No one wants to accuse the industry of lying to investors about risks, but this is pretty close, he says. And it's important. Longer loan terms make payments more affordable for cash-strapped consumers. And so if you're extending people's car loans for cash-strapped people because they can't afford it unless you do so, I'm sure they can continue getting a mortgage, you know what I mean? Paying a high price for a new high-priced house. Real estate's at the all-time high. And as they keep telling us, real estate keeps going up. You have nothing to worry about. Real estate keeps going up. But if it goes up right when you need to buy that house and you can't afford to even pay your car or go get a new car because you can't afford a 60 months, so now you got to go to 72 months, what is that saying? There's no disposable income for that person whatsoever. And if anything happens with their mortgage payment or car payment, it's a adjustable rate here, adjustable rate in the mortgage. Oh my God, they're done. They're finished. As underwriting standards have gotten very loosey-goosey starting in 2013, loan terms, along with loan-to-value ratios, wandered off into new territory. Actually, I skipped a couple sentences. And it's important. Long-term loans make payments more affordable for cash-strapped consumers. Thus, they pump up sales volume, and they allow finance companies and dealers to make higher profits. As underwriting standards got very loosey-goosey starting in 2013, loan terms, along with loan-to-value ratios, wandered off into new territory. But as loan terms lengthened, depreciation of the vehicle outruns the amortization of the loan principal for longer, and borrowers have negative equity for longer, which raises the risk of loss, particularly for subprime loans. And Fitch says this will pressure recovery values on defaulted loans and also hurt customer trade-ins, which could negatively affect future new car sales and financings. I said this, I think, in my last video when I talked about the auto industry, which I don't know how long ago that was, maybe 2 months, 3 months, I'm not even sure. And I said this, correct me if I'm wrong, maybe it was the one before that, but I'm sure some of you will remember this. I said, if you want to make some good money, get into the repo business. It's going to be tough. Believe me, people are going to get more irate, more crazy. I got to have my car. You can't take my effing car. I need it for work. I mean, they're going to get crazy. But the amount of work out there, you could do really, really good. You could go to work for a recovery agency company and make good money. So if anyone's out there struggling or thinking about job change, and you're willing to take on a little bit of that risk of dealing with very irate people, I think that's an industry that's going to really be booming soon. And it won't, well, I was going to say there's not going to be a bubble. There's not going to be creating a bubble, like something pushing it into a bubble. It'll become a bubble because of so many of the defaults. It'll just look like a bubble. And it'll slow down once that's taken care of, but I don't see it slowing down for quite a while, to be honest with you. Could be some good money made there. Why is this important for the industry as a whole, not just lenders and their investors? Lenders are starting to feel the bite of those losses that are made worse by extended loan terms, higher loan-to-value ratios, a higher proportion of subprime loans, more negative equity for longer, and hence subprime defaults and net charge-offs that are soaring to crisis levels. The spiral is made worse. Matter of fact, I got to stop because I got a thought in my head that won't leave. It's forcing me to stop. Hold on. Spirit's coming through. Spirit's coming through. Stand by. No. What's coming through is the thought when I was telling you in my, I think it was my last video, about the TV show I saw, how they follow the guy around, how he, just has ideas. He'd fix up cars, make a couple $100 selling a car. He got the idea. I'll get into tax returns because a lot of people buy cars with their tax return money. And he lives and works in the ghetto, so they can't afford a lot over there. But he realized I can have the client come in for tax returns, get them their tax return, take the money out immediately for the car. Here's 3 cars I have for you. Pick one, test drive it, see which one you like, and then I'm only asking $1,600 for that one. And of course, your tax fee today was $200, but right, he had it down. So this came into my head. And if that guy's listening, which he's not, but if he was, start a auto recovery service. Work for the banks, recover the cars that the people couldn't pay on. Ask the bank, what do you need to get out of this? What would you like to sell this for? It'll stay on my lot. I'm not even going to charge you the storage fees that you normally would get charged. That's why you're going to work with me. I'm going to be your number one guy. No storage fees here. Leave it on my lot. I have another business where I do tax returns. People come in all the time with used cars, and the beauty is they have cash money. So what is owed on this particular car? And what would you feel comfortable? Just flip it right away. No loan, just cash money right back at you. Oh, well, we would need this. No problem. Got you covered. They made the interest all that time that person was paying on it. Now they're not. For years, they've got it. Now they're not. And they get to sell it for cash money for the remaining balance. The bank would be very happy. So if anyone took that to heart, I think I just got you a triple double. Start those businesses and you are set. So now that thought's out of my head, let me finish here. Let's see, where was I? Lenders are starting to feel the bite of those losses that are made worse by extended loan terms, higher loan-to-value ratios, a higher proportion of subprime loans, more negative equity for longer, and hence subprime defaults and net charge-offs that are soaring to crisis levels. This spiral is made worse by dropping wholesale prices of used vehicles when they're sold at auction, which is where lenders unload repossessed vehicles. Again, you don't even have to do that. Take it to Joe's new company. He'll take care of you. To tamp down on future losses, lenders began tightening underwriting standards, particularly in the subprime segment in 2016. Fitch cited the Federal Reserve's January 2017 Senior Loan Officer Survey. In the survey, pricing, minimum down payment, and minimum credit were all tightened by respondents on a net basis, although the maximum loan maturity continued to lengthen. So at this point, despite tightening in some areas, lenders continue to lengthen the loan terms. Why? Because shortening terms in face of high prices and hence unaffordable payments for stretched consumers would strangle sales volume and profits. But they are getting nervous. The overall tightening of underwriting standards is consistent with comments made by several banks on earnings conference calls over the past couple of quarters. Fitch believes the tightening of underwriting standards is a response to expected deterioration in used vehicle prices and the weaker credit performance experienced in the subprime segment. That'd be a pretty good assessment. I would say, I kind of see this one coming from a mile away. This deterioration in used vehicle wholesale prices came to the fore in the National Association of Auto Dealers' gloomy report on February. Its used vehicle price index plunged 8% from a year earlier and 13% from the peak in 2014 to hit the lowest level since September 2010, and it's just the beginning. Fitch continues to expect used car values to gradually decline over the next several years as used vehicle supply rises, driven by increasing volumes of off-lease vehicles, which are expected to increase by over 50% between 2015 and 2018. Boy, it is almost time for Jason Ford to get rid of that old 2004 Crown Victoria X police car. You know what I really want? I got any rich subscribers? What's wrong? Throw a little bonus to Jason. Walk outside my house and see a nice 2010, 11, 12 Chevy police pursuit vehicle, Tahoe. Love those vehicles, Chevy Tahoe. And long story short, ultimately, when it's time to get rid of that car, I want to get one of those. They're just fantastic. I actually had a 2006 when I was in Tennessee. It's not the new body style, and I love the new body style. I love the way they look, and I'm talking about the police package one with the little spotlight and the little rims, the special rims they have, and a push bumper. That's what Jason for wants. But since I don't have any rich subscribers who want to throw a lottery ticket Jason For's way, I'll just save up. Appreciate you guys. The surge in supply comes as rental car companies are right-sizing their fleets and their units are flooding the auctions. And it comes as automakers are piling on incentives to sell down bloated dealer inventories of new vehicles and keep plants open. Keep plants open, thus making new vehicles more competitive with late model auction units. Did I not tell you the other day? Guys, I've been looking like on Craigslist. 2014, 2015, Nissan Leaf, 100% electric, no gas at all. It had a range of about 100 miles. This year, 2017, it's going to double to 200 years from what I heard. However, these things, I'm looking at them, 14,000 miles, 6,000 miles, 20,000 miles. Did I tell you again, 2015s, 2014s? 11,000, 10,000 bucks. Whoa. Complete electric vehicle? Now, granted, 100 miles, that's not really good, but 200 miles? I might be able to work with that. We got the van, gasoline. We got to go somewhere far, we take the van. For me going to work and back, take the Nissan Leaf. But I don't want to Leaf. Why? Because I want that damn Tahoe Police Edition. Police Pursuit Vehicle is what they called it. And gas prices aren't going anywhere right now. Why not? I'm sure if I were to sell it, I'd be able to get a nicer Nissan Leaf because those things are going for like $12K right now, $13K for the 2010-11 Tahoe with the 100,000 miles on it. So the new vehicle demand is believed to have plateaued, as Fitch put it. This lack of demand in face of surging supply pushes vehicle values lower, which adds downward pressure on lenders' recovery values and lease residuals. Lease residuals is a term that has started to crop up in earnings warnings. When you lease a car, the lender puts an estimated value on the vehicle at the end of the lease term. This is the part of the vehicle that you never pay for. The higher this residual value, the lower the monthly payment. At the end of the lease, you turn in the vehicle and it is then sold at auction. As wholesale prices drop, residual values are underwater and lenders are taking losses on them. And this is starting to happen. How big is leasing? It's actually huge, he says. Leases account for 30% of total auto financings, hence the earnings warning. And Fitch anticipates this course will get worse. Then there are knock-on effects. Bleeding lenders, lower residual values on new leases. This causes monthly payments to rise, making the vehicle less affordable to stretch consumers, and thus more difficult to sell, just when demand has already peaked, and when subprime is getting crushed. Let's hope that the problems piling up in the used vehicle market and their impact on new vehicle sales, automakers' $1.1 trillion in auto loans and auto lenders, is just a blip. No trend, just a blip. It's going to turn around in the near future. You know that that's not going to happen. This will continue to get worse. Now, I'll be honest. I didn't know that 1 out of 3 auto loans are for leases. Are you effing kidding me? You're going to lease a car for 3 years. That's usually the typical. Make that payment 3 years. Well, it's a little bit less than a car payment. Okay, whatever. Because you get a nicer car. I get to drive a nicer car for the same amount as I normally would pay. Okay. But you don't ever freaking own the car. Turn it back in. Oh, you went over your mileage. Gonna dock you on that. Oh, so it's got some scratches and stuff. Dock you on that. Dock you on that. But anyways, thanks for coming back. Hey, oh, we need $4,000 down for this lease. Give me $4,000 down. Make your payments for 3 years. Good. Make sure you don't go over that mileage number. You'll be in trouble if you do. And then what do? I'm going to lease again. And I'm thinking to myself, J-Step 4 style, $4,000 or so, and it ranges for a down payment to lease. That's like giving a down payment to rent a house. Oh, wait, we already do that. Security deposit, first month, last month. Oh, well, we're just doing cars too. How much did I pay for that damn Crown Victoria? $2,800. Had to put 2 wheel hubs on the front for maybe $100 something bucks. Maybe I think it was less than $100. All I've had to do to that car. That's it. I'm riding that horse till it dies. And when it dies, my dad's like, "Oh, well, Dad, do you want my car? If I get in the car, if I get one of these Leafs, do you want them? Yeah, I'll take your car. Okay. Yeah, I want your car. I want to get behind some of these jerks that drive like assholes. And your car with the push bumper, And he's right. They don't know. Is it real? Is it fake? They drive nice and calm when you're around. No road ragers. Everybody's calm. Oh, is that a cop car? Is it undercover? Is it not? I don't know. I don't want to take a chance because I'm strapped. I'm a strapped consumer. God help me if I get a $260 ticket right now. Oh, let me drive normal. No, you can drive like a jerk. It's just Jason 4 on Realist News. It's just me. Continue driving like a moron. Anyways, take care.